Hi, my name is Larry DeBoer, and I'm a professor in the Agricultural Economics Department and a specialist with the Cooperative Extension Service at Purdue University in West Lafayette, Indiana. Welcome to our series of videos about Indiana local government. Today, let's talk about property taxes. In most places in the United States, the property tax is the main source of tax revenue for local governments. Counties, cities, school districts, libraries, townships, and so forth. That's certainly true in Indiana. The property tax is also important for taxpayers. If you own a home or a business, if you're a farmer with farmland or a landlord with rental property, you probably pay the property tax. So, let's start with the basics. In Indiana, there are three terms you need to know to understand the property tax, and they are assessed value, tax levy, and tax rate. Let's start with assessed value. Assessed value is the base of the property tax, the thing that is taxed. The property tax is different from the income or sales tax because there isn't always a record of what to tax, like a paycheck or a sales receipt. For the property tax, you could pay a percentage of the selling price of your property, except most property doesn't sell every year. So what can we do? We have to estimate property value. The Indiana Supreme Court established a standard for these estimates in an important decision in December 1998. To paraphrase, the standard is objective measures of property wealth. We elect assessors to estimate the value of property. The objective measures that assessors use are numbers like selling prices for property that sells, rents earned on rental property, or construction costs to replace a structure. For most property, the assessment is a prediction of what the property could sell for if it was sold in the market to a disinterested stranger. That's often called market value. Since 2007 in Indiana, property assessments have been adjusted each year to account for changes in selling prices, rents, and costs. That's a process called trending. Every once in a while, property is reassessed. Data on the characteristics of property are collected anew: square footage, building materials, number of rooms, and so forth. That's to make sure the data are up to date and accurate. Indiana finished a statewide reassessment for taxes in 2013. Starting in 2015, though, reassessment will go to a 4-year cycle, with 1/4 of the property in each county reassessed each year. So, assessed value is the base of the property tax, which is the dollar value placed on taxable property by the local assessor. It's based on objective measures of property wealth called market value. They're trended each year, and every so often we collect a lot of new data in a statewide reassessment. Now, let's move on to the tax levy. The tax levy is the amount of property tax revenue that local governments intend to collect. The levy is limited by the state property tax controls for most property tax revenue. There is a maximum levy that local governments can collect, and most local governments set their levies right at that maximum. The maximum levy increases each year based on changes in Indiana total personal income. Lately, the increase has been about 3% per year. The property tax levy is divided among a local government's funds. The general fund is usually the big one. Its revenue is used to support the operating costs of the government, which is mostly pay and benefits of employees. Other funds include the school and library capital projects funds, several cumulative funds, and debt service funds. Not all of these funds are subject to the maximum levy. Debt service funds, for example, collect property tax revenue to pay back money that's been borrowed for big infrastructure projects. Those levies are set by the borrowing repayment schedule. Property tax levies support most local governments. School corporations, counties, and cities and towns receive the most. Maybe you noticed that I said the levy was the amount local governments intend to collect. Sometimes actual revenues fall short of intentions. The tax caps may limit a taxpayer's payment to less than the full tax bill. Taxpayers get a credit for any amount above the caps, and local government doesn't get the revenue. And some taxes will be delinquent. People owe taxes on their property but don't pay. That's a particular problem after recessions. So, the tax levy is the property tax revenue that local governments intend to collect. The amount is controlled by state rules. It goes into several funds, the biggest of which is the general fund. Not all of the levy is collected because of tax delinquency or tax cap credits. Now, the tax rate. Here's another way that the property tax is different from income taxes or sales taxes. With the income tax, the legislature sets a tax rate, a flat 3.4% in Indiana, and taxpayers pay that percentage of their taxable income. With the sales tax, the legislature sets a tax rate, 7% in Indiana, and taxpayers pay that percentage of their taxable sales. With a property tax, the local government sets the levy, the amount to be collected, and then fixes the rate to collect that amount. They divide the levy by assessed value, and the result is the rate. That way, multiplying the rate by the assessed value of each property delivers the needed tax levy. That means the tax rate can differ for each local government in Indiana and usually changes from year to year. Rates work like this. Each local government sets its levy and then divides by the assessed value of the property within its borders to get the rate. A taxpayer's property would be located inside the borders of several different local government units. A property will be within a county and a township and a school corporation and might be in a city or town, a library district, or other special district. The rates of each of these units are added up, and that's the rate that the taxpayer pays. In Indiana, we express rates as dollars per $100 assessed value. That's really the same as a percentage. For example, a $2 rate means the taxpayer owes taxes equal to 2% of the value of his or her property. So, each local government sets its tax rate by dividing its levy by its assessed value. Tax rates vary across local governments and year to year. The taxpayer pays the sum of the rates of the local governments in which the property is located. That's it, the basics. Is there more? Oh my gosh, yes. But if you know assessed value, levy, and rate, you're on your way to figuring it all out. We'll have more videos to help with that. Thanks for watching. I'm Larry DeBoer.